Hey everybody, welcome to this course brought to you by our friends at Club Capital. Louisa and Anatole are going to give you so much powerful information that you can utilize today to start saving money on taxes, increasing your cash flow, putting the money back into your business and or even outside of that business, paying yourself more, doing other side businesses, right, to diversify what you're doing. What I want to challenge you to do is get ready to take a ton of notes because they're going to share so many powerful tips and information, things that you can use. But I do want to give a quick recommendation. If you are not already utilizing Club Capital, if you're not utilizing a company like a Club Capital to handle your accounting, you're missing out. You might be using an accountant that's been in the business for 30 something years doing all different types of other businesses and personal returns. They don't know insurance agencies like Club Capital. You see, Club Capital only works with insurance agencies. And what's really neat is they can like benchmark you with agencies of your similar revenue and size. They can say, okay, based on your revenue and size, this is where you're at in terms of spend of payroll, percent of revenue, spend for marketing, leads, paying for yourself, et cetera. And you can just see if there's like any outliers or things like that. That's really cool. But y'all, they know how to really maximize your tax savings, maximize your cash flow, and help you grow and transform your agency. So I would highly encourage you to check out Club Capital, check out their website. I'll put the link right here. Check out their website and reach out to them, set up a conversation to see if they'd be a good fit for you. What would you tell an individual, a consumer, if they said, I'm just going to handle my insurance on my own, right? Anybody can buy their own insurance online. Wouldn't you advise that they work with you as a professional because you're an insurance professional and your team are licensed insurance professionals, can make sure they have the right coverages, appropriate deductibles, every discount possible, and just truly have what they need? Well, if you answer, yeah, duh, Joseph, of course I would tell somebody not to be their own insurance agent. Y'all, if you're doing the TurboTax thing or using some old accountant that doesn't know what they're doing with insurance agencies, please reach out to Club Capital. Dozens and dozens of CWC member agencies work with them, and they work with hundreds of insurance agencies all across the country, and they know what they're doing. All right, so just check them out at Club Capital, and let's see where the conversation goes as you talk with them. All right, get ready to learn. Take a ton of notes. Man, they got a bunch of slides to go through and lots of great information that you can start utilizing today.
Well, we're really excited here today to talk about one of the things that really captures a lot of attention here, the shift from being an operator in your business to an owner mindset. To quickly introduce ourselves, my name is Anatole. I'm the VP of Operations here at Club Capital, and I'll toss it over to Louisa to introduce herself.
Hi, my name is Louisa Elzy. I am the general manager here at Club Capital. I am a CPA with tons of experience and background in both tax and accounting, working with agents every day to help them make this jump that we're going to talk about here today.
So thanks, Louisa. And we're really excited because the goal for the course today is to help you start thinking like a true business owner. And what I mean by that is using financial and tax strategies to help you, one, grow revenue, and two, keep more of your profits. So we're going to cover two topics. That first one is the mindset shift from, accounting and taxes are an evil necessity to how can I use them to grow my business? And then the second thing we're going to cover is tactical tax strategies that you can take away and use in your business. That's a big hit. Whenever Louisa talks to our clients about it, it's something they're very interested in. So be sure to stick around at the end of the course to listen to that. So real quickly, you're probably wondering, who is Club Capital? Well, we are the largest agency-focused accounting and advisory firm in the country. So we work with only insurance agency owners. We have 700 plus, I think it's 750 now, agents or more across all major carriers, across every state in the United States. And our only focus is insurance agents. So we are here to help you out. And we're here to share some of the learnings that we've seen from, I think now it's our 8th year in business. So we're really here to help you understand what you can do with your taxes and what you can do with your financials to help grow your business. Our goal here at Club Capital is to help agents become better business owners. And that's why we really want to help you make the shift from that operator mindset to being a true business owner. And so why we get up in the morning, we want to help you grow your profits or grow your revenue, keep more of those profits, and then help you for whenever your exit is going to come up, whether you want to retire in 5 years, 10 years. How do we maximize your exit from the agency? That's why we're here. That's why we get up in the morning. And that's what we're about here at Club Capital.
So Anatol has said this a couple times now as we're talking through this owner to operator, and really it's a mindset shift, and it's also a focus shift of your day-to-day operations. So when you're an operator, you think about it, that business is running you. You are dealing with everything that comes up, every fire, every help me, every client coming through the door, every policy going wrong. You are jumping in and you are taking care of that, and you are going so quickly from step to step that you are not taking the time to think strategically about your business. Your business is dictating where you go every day and how you operate. As an owner, when you really make that shift, it's you making the choices, your focus on the business as a whole. It's not moving from fire to fire, it's being strategic. It's saying, these are the goals I want to achieve, and this is how I get there. You cannot be a true owner of your business without having a full understanding and grasp of what your business is doing. And that's where the financials and the tax come into such big play. You ever feel like you're going by your gut? That means your business is running you. You're being an operator. To be an owner, you're not going by your gut. You're going by facts. You're going by trends. And that's really what our focus is helping you identify those and seeing places where you can grow your business and be strategic.
And Louisa, I think that's a challenge for a lot of clients that we see and a lot of insurance agency owners, right? It's hard when you've started and you've worked your butt off for those first years being an operator in the business to have that mind set shift to being an owner. I think that's a hard challenge, and it's something that we really work with a lot of folks on, and we want to help you make that shift. So I think it's an important shift to make for sure. And when we think about this shift, Louisa, one thing that we see is the shift from just thinking about bookkeeping to strategic accounting and what that means for a business owner. So I don't know if you have any context there that you really want to talk about, but I think that's an important distinction too that goes along with that mindset shift.
Yeah, absolutely. So there are things you have to get done. You have to have your books done, whether you do it annually when you take your shoebox. I know, Anatol, you love my shoebox example. It's real life. I've done it. When you take your shoebox to your accountant at the end of the year, same thing. You have to do your books. You have to do your taxes in some way, shape, or form. But what we want to see and what we want business owners to be able to do is to elevate that another step. It's not doing your books and doing your bookkeeping for the sake of checking a box, for the sake of going to your CPA in February, March, and saying, here's my stuff. It's doing the bookkeeping, the stuff, the bottom line stuff that has to get done so that you can see it and make decisions. And to do that, you have to see it all the time. You have to see it when it's happening. You have to see it last quarter, last month, whatever those results are, so that you can see how the decisions you're making are affecting your bottom line. So to be truly having strategic accounting, working closely with an advisor, whoever that may be, it's being in your books, and it's having your books done, but it's not for the sake of, oh, I gotta do my bookkeeping, what a pain. It's, hey, my books are ready, I'm doing my bookkeeping. That means I can see everything going on and I can make these really informed decisions. I don't have to go by my gut anymore because I can see the example, I can see how my decisions are working.
And it's such a powerful tool to help you grow your business, right? Going back to the goal to help grow the business, to help increase profits, to help maximizing your exit, being on top of your books and using them strategically is such a powerful tool. And when we talk about strategic accounting, I think this goes hand in hand with it, right? You can't manage if you don't measure. So if you're not measuring as you go along, it's going to be difficult, if not impossible, to make decisions based on that data. One of the big analogies that I like to think of is if you're flying a plane in clear skies, great. You can maybe just eyeball it, judge it, go with your gut. But what happens if a storm comes in and you're trying to figure out how to land the plane and you can't see 2 feet in front of you? You're going to rely on your dials. You're going to rely on your altimeter. all of the different indicators that you need to land this plane. And so when we think of strategic accounting, that's what's going to help us in difficult times make decisions based on data that are going to give you the confidence that this is the right decision for you. So it's just another analogy, I think, that really helps clarify why it's so important to step back from running around with your head cut off being the operator to looking at your business as a whole and making those data-driven decisions.
Yeah, and that's such an important task, to be able to measure and keep an eye on things. And one of the things we see a lot is we have agents come in who really want to work with us, and their laser focus is on tax savings. They want to come to us because they want to save money on taxes. They want to go to their CPA and get all their tax saving strategies, and that's great. That's super important. That's a great goal to have. But we really want to challenge agents, and agency owners to really kind of flip that script a little bit. Because when we look at things, you can kind of tell from how we've been talking about this already. We didn't start saying, hey, taxes are really important. Let's save you on taxes. We started with this whole mind shift. And because that has so much more to do with everything in your agency as a whole than just focusing on taxes. Taxes are a natural extension of feeling like this and of managing and being ahead of your numbers. There are great strategies that are available to different agents. Some really common ones, some very unique ones, depending on your situation. Um, but all of those strategies, we can't start them until we know where your books are at, how your agency is performing. So it's kind of putting the cart before the horse to say, hey, let's talk about saving me taxes. Because the first thing, if you come to me as your CPA and you say, save me money on taxes, I'm going to ask you, well, how's your business doing? What are you spending money on right now? What's your bottom line look like? And until we have those answers, I can't give you tax minimization strategies or suggestions because I don't have an understanding of what you're doing already and how your business is performing.
So as Louisa was mentioning, like we can't put the cart before the horse in terms of tax strategy. Like we need accurate financials to make sure that you're getting the best tax strategies possible for your specific situation. And that's because a lot of these tax saving strategies require cash outlays. So it's a question of, are we going to invest in future business growth? It's a question of, do we really want to save taxes this year? It kind of goes back to really what your goal is and what those financials are telling you and where you want to invest in your business. So I know, Louisa, you've probably seen examples of this. We talk about the shoebox all the time, but it's just something that I feel is really important that to discuss, that hey, we need to just understand this.
Yeah, if you're not making money, I can save you taxes really easily. You don't owe tax if your taxable income is zero. Um, but the really common, more talked about tax strategies, a lot of these more high level strategies, they're not free. I'm not, and they're not even dollar for dollar. There are very few tax strategies that we're going to talk about that I'm going to say, if you go spend $10,000, you're going to save $10,000 on taxes. That's not how things work. The IRS gives very few credits. They have some, right? If you're on the individual side, child tax credit, probably the most common one. No matter where you're at, basically, there are some limitations, but essentially we all get an extra $2,000 a child. It's great. I take very much advantage of it with my two kids. But there aren't very many of those, especially for business owners. And so all of the strategies we talk about, there's a weighing of that. Like you mentioned, Anatole. I want to fund my retirement plan. That's awesome. I'm going to put $10,000 into my retirement, and I'm going to save 3, 4, 5 and on taxes. And so that's really great. You're saving a great chunk on taxes, but you have to be willing to have that $20,000 leave your bank account and get locked up until you're retired, with limited exceptions to that. So a lot of these, almost all of these strategies that we're going to talk about, it is you weighing what makes more sense, and what's worth it to you as the taxpayer, as the agency owner. And so that's really coming back to knowing what your goals are, being in your books, being in your results. So you know what makes sense, you know what cash you have to play around with.
And regardless of the tax strategies, guess what? The IRS is not going away. So we're going to always have this silent business partner. And I think it's good to put in context, right? What this means for your business. So if you're doing $1 million in revenue and your profit margins are about 25%. So you're getting 250K in profit. Well, in the highest tax bracket, you're probably paying on that $1 million about $110,000 to the IRS. So again, when Louisa was talking about what are the best strategies to address this and what do we want from your business, it's important to keep in mind, regardless of the tax strategy, it's not necessarily a bad thing that you're paying taxes because it means you're making money. But it's just a question of what's best for your business in this specific moment and how do we want to address the tax strategy associated with that.
So when we get past that point, when we say, all right, I've got a handle on my financials, all right, I'm profitable, I'm making money, let's look to see how I can pay my fair share, but not a penny more to the IRS, that is when we get to these different approaches and these different strategies. And all the strategies we look at that we're going to talk about, there are really two little sections they fall under. The first is reducing profit. This is very straightforward. Spend all the money you need to spend. Maximize your business expenses. If you need to go buy a whole bunch of printer paper at Office Depot or at Staples, go buy it. It's a write-off. It reduces your taxable income. It's that straightforward. Option two, the second kind of bucket they're going to fall under is a little bit different. It takes a little bit more thinking through. They're often a little bit more complicated. But these are ways where when you have that extra cash, like I talked about, you find different ways to defer taxes on them, to have the timing of the tax hit differently, to move them around. These are things like contributing to retirement plans, putting your kids on payroll, and then coupling that with some retirement plan options. So things that are not necessarily going to save you taxes forever, but are going to change the timing of when you're paying those taxes. And so that's kind of the two buckets that any tax strategy is going to fall into one or the other of.
But I think it's an important call out. We have to talk about Ebitda because it's still a huge measure of agency efficiency, right? And so, yes, we could reduce profit, but that will impact your Ebitda, right? So it's again a balancing act. And why is Ebitda so important? I think it's a good thing to talk about before maybe we offer some of these tax strategies because it's a great thing to keep top of mind and it's a super important thing for business owners.
Yeah, as Anatole was saying, EBITDA is very important because that's part of your business operation. And one thing I have a lot of conversations about with clients is that tax is only one part of your business, and the decisions you make for taxes are not necessarily the decisions that's best for your company as a whole. Whether that's incorporation or whether that's spending or setting up benefits, uh, things that make your taxable income look good maybe don't make you look good for that exit strategy we talked about earlier. So it's important to remember that nothing exists in a vacuum with your business. It's great to save taxes, but if saving those taxes makes your business and your EBITDA less effective, less impressive looking, depending on what your current plans are for your business, you might be shooting yourself in the foot, giving yourself a lower valuation. Just because you wanted to save taxes for a couple years, and in the grand scheme of things, you just lost out on a whole lot of exits, money on your exit if that's where you're going towards. So one thing I just always want to talk to people about in the broader scope is that taxes are one piece of the puzzle for your business, and I never want you to make a decision solely because of how many tax dollars it's going to save you. And in that same vein of making sure that you're not spending just to save money, one thing we want to point out is that, first of all, not all money you spend counts as a tax deduction. So you can't decide that you're going to fly to Hawaii and charge that to the business. Now, if you have a valid business purpose, sure, go to Hawaii, wherever Joseph is jetting off to next. But it's not just a license to throw anything in everything into your business. The one thing that we really want to keep an eye on is the fact that, again, I said this before, it's not a dollar for dollar reduction of your taxes. So spending money on things that make sense is fantastic. Business expenses that are coming up anyway, maybe you accelerate them into December instead of January. Buying a vehicle that you're going to use for your business, great write-offs related to vehicles. We'll talk about those more later. Cost segmentation, accelerating write-offs you're going to get anyways, all really important and useful tools. Going out and buying a car that you don't need with cash you maybe don't have just so you don't pay taxes this year, not smart. It's great for your taxes, but it's not great for your bottom line. It's not great for your checkbook. It's not great for your future. So really keeping a close tab on, again, making decisions not just for your taxes, but tax decisions that also are going to benefit your business.
So we've talked in generalities so far about tax minimization strategies, but what we want to do for you folks is give you 8 concrete tax minimization strategies that you can take away and you can apply to your business if, again, it's applicable. As Louisa mentioned, this is not a license to go spend money, buy the new G Wagon or whatever it is that you want. These are tax minimization strategies that should be applied to the overall business strategy that you have. So we'll go through each one of these in detail and explain how you could use them in your business.
The first thing we want to emphasize is some changes to meals and entertainment that are coming up for 2023. We're really going back to pre-2020 rules with this, but we did kind of get a little lazy, get a little luxury here in the last couple of years with some lacks of these rules. If you remember it all during COVID, one of the many things that came out was some legislation, and part of that legislation was making meals and meals deductions, not entertainment, 100% deductible temporarily through 2022. The idea was we want to keep restaurants in business. Let's incentivize anybody any way we can to go get that takeout box. So businesses got to write off the full cost of all those meals instead of just half of them like they had historically. All of those are sadly going away now. And we are back to the pre-2020, post-2018 rules. And what those basically are is you cannot deduct any entertainment. That hasn't changed from 2022. That wasn't allowed before either. It was prior to the 2018 tax reform. Entertainment used to be 50. Part of that 2018 reform is it went to 0. So entertainment is very straightforward. You can't deduct it. You go golfing with a potential buyer. Too bad. I hope you enjoyed your golf, but you can't write it off. If you buy their game, still can't write theirs off. But then when we go to different types of meals, that is where there's some strategy that can be involved. So meals overall are only 50% deductible. This came from the idea that if you take somebody out to dinner trying to win their business, you can't write off your own meal. You're going to be buying your meal anyway, but you can certainly write off the meal that you bought for your client or prospective client. But there are some exceptions when it comes to your employees. And the key to keep in mind here is that you want to be treating your whole employee, your whole staff. So more than 50% of your staff, an office-wide party, you bring dinner in, you bring lunch in to celebrate, that's 100% deductible. That's a party, that's celebration. We at Club Capital, we call that employee relations, just to bifurcate it out. So when we look at meals, we know that it's separated from that. Unfortunately, travel is still only 50%. So if you're sending your team on a trip, you can still only deduct 50% of that. So just something to keep an eye on. Kind of back to the old rules, so nothing super new out of the blue, but it is a change from what we've gotten used to in the last couple of years, and definitely impactful as we're making decisions on how we spend, and also as we're coding things and making sure we're keeping track of our spending appropriately, since there is a different tax treatment to some of those. So the next strategy that we talk with a lot of agents about, and I know that you've heard it if you are tapped into any groups, is adding your kids and adding your spouses to payroll. This is a great strategy, and it's a great way to not only save some taxes, but really, especially with your kids, invest in your kids. So going back to that idea of we save on taxes, but that's not everything we're doing. We don't do things purely for tax savings. We do them for a bigger reason, bigger business reason. In this case, a bigger personal reason. As small business owners, not small in the business, but small as in you're the only owner of your business. You have some advantages and things that not everybody has access to. I don't have access to it for my kids because of the way I work. My job is structured with Club Capital. And so the idea behind adding your spouse or your children to payroll is specifically, we can kind of look at this in 2 buckets. Kids is the first one. Kids has a few more tax advantages than spouses. So when it comes to your kids, if you are organized as a sole proprietorship, your kids are excluded from all kinds of like payroll taxes, unemployment, FICA, FUTA, the Social Security taxes. They still have to pay their federal withholding taxes. But at the end of the day, they're not going to be there. If you pay them the right amount, you're not going to have to pay any taxes and they'll get that refund. If you are incorporated, unfortunately, they still are subject to those Social Security type taxes. But again, if you keep an eye on where you pay them, what their payroll level is, you can actually pay them up to $13,000 without them being taxed on it, without federal income tax. And the way that works, if you think through it, is the standard deduction for any single taxpayer in 2023 is $13,850. That means any of us, child, parent, whoever, if I only earn $13,850, and my standard deduction as a single taxpayer is the same. My taxable income is zero. I don't pay any tax. It's not subject to taxes. That applies to anyone. It generally comes into play with kids, right? Because most of us need to make more than $13,000 to live and to sustain our lifestyles. But for our children, we can pay them up to that amount. If we're sole props, have them pay no taxes on it. If we're corps, have them to pay no income taxes on it, but still a little bit of those payroll taxes. And what happens then is you do, like I said, you have to put them on payroll. You have to take the federal taxes out, just like any of us do. And then they have to turn around and file a tax return. And when that tax return shows $0 of taxable income, they get whatever was kept out of their paychecks back. That alone is a great tax strategy. You're moving money from your bank account to your kid's bank account, and you're not paying tax on it. It's a write-off for your business. It's not going to end up being taxable for them. But there are ways you can couple this to make it really, really tax advantageous and really set your kids up for future success. The key to this is using the tool of a Roth IRA. Anytime you hear Roth, what it means is down the road, it's not, when you take funds out of it, you're not paying taxes on those funds. So it's not a deduction right now. You pay taxes on any money you put into a Roth like normal. But then down the road, you've already paid tax on it, so it's tax-free. And so by setting up a Roth for your child has to have earned income to contribute to a Roth. Well, you've just given them earned income by putting them on payroll. And so you contribute roughly half of their income to a Roth IRA. And since technically it was subject to tax right now, it won't be subject to tax when you pull it out. I say technically because remember we just talked about if you pay them $13,850 or less, they're not going to pay any taxes on it because it's lower than the standard deduction. So it's a great tool to go ahead and save some taxes now for you personally, and also set your kids up with some great tax savings later. And the other way we look at this is to put your spouse on payroll, and you can take a little bit different approach to this. There are not those great tax savings of not subject to FICA food taxes, anything like that. So if you put your spouse on payroll, on paper at first look, it's just like hiring any other employee. But what you can do, since you're both having your income come through to the same tax return, there are a little bit more strategies we can play around with it. The great thing, where this comes into play and being really putting your spouse on payroll is if you offer a 401k plan or another retirement plan. In this case, we talked about Roth before. In this case, we would think about using a traditional IRA or traditional 401k plan and maxing out your spouse's contribution to it. So if the max 401k contribution is around $30,000, put your spouse on payroll for $30,000 and then have your spouse elect to put all $30,000 of that into the company 401k plan. And what that does is it defers all of that income to be taxable later. So again, it's a write-off for your business right now. You're paying tax on $30,000 less. But since your spouse is choosing to defer that into a traditional 401k plan, they're not paying taxes on it either. If they don't defer that, if you just put your spouse on payroll, pay them $30,000 and they say, cool, it's essentially a net zero on your taxes, roughly. But if they choose to then couple that with the deferral into the traditional 401k plan, you've now shifted and kind of kicked down the line taxes on $30,000. And that $30,000 is going to earn money. It's going to go into a 401k plan and it's going to fund your retirement.
So continuing on that theme, right, of how do we use your spouse or how do we use your child to offset potentially some taxes and leverage it? Again, going back to building wealth and building for the future. Louisa, if you want to maybe talk about another way, potentially with healthcare or something like that, that you could leverage your spouse or child to offset some of those taxes, that would be great.
Yeah, so I really touched on this a lot already, but just kind of to reemphasize and kind of talk through really leveraging those benefits. for two pieces. The first is when we have our spouses or our kids involved. I hit on this already. If we have a retirement plan set up, not only can our spouses max out, I talked about the Roth IRA for our kids. If you have a Roth 401k option for your kids, they can't just do, then they don't just have the 6,500, that's the IRA. They can max out and put their entire salary into a Roth 401k. So that's really great. That just continues to build on the tools you've already done with putting them on payroll, but also investing in their future, investing in your future when it comes to building your own retirement plans and building generational wealth here. It's a great tool to set your kids up. And then the other piece, when you take a step back, is really just offering benefits is a great recruitment tool. It's a great retention tool for any employees, not just your family. And you get a tax write-off for that. There's nothing fancy, nothing exciting about that, but it's a deduction for you. And it's a great tool to keep your people around, tell them how much you care about them and you're invested in them and their lives, not just in what they come do and check the boxes for you every day.
Thanks, Louisa. That's really helpful. Let's talk about one that I'm sure folks have seen on Instagram, or I've seen it on Instagram, Facebook. I'm sure the younger folks have seen it on TikTok. Talk to me about whether I can buy Escalade and just write it off totally, and it's great for my business, right, Louisa?
Sure. Let's caveat that a little bit. So there is a great tax tool. It's called Section 179. Also, sometimes talked about bonus depreciation, though if you want me to get tax nitty gritty, they are different things. That people use a lot, and not just in the insurance agent world, but we see a lot of agents do this as well. And it's specifically talking about vehicles. So to qualify for this great write-off, it doesn't have to be a vehicle. We see it come into vehicles. But if it's a vehicle, it has to be over 6,000 pounds. So you can't go buy a little Camry. It needs to be, if not an Escalade, a larger SUV, things like that. And it has to be new to you. It doesn't have to be a brand new vehicle. Please don't go tell anybody I'm telling you go buy the fanciest car off the line in order to qualify for this. It has to be new to you. And the other caveat here that we don't have on the slide is that you need to use it more than 50% of the time for your business. So it does have to be a business vehicle. You can use it for personal as well. We all know that we kind of use our vehicles both, especially in the post-COVID age. But it does have to be used primarily for business. And what that allows you to do is it allows you to write off the bulk, if not all, of the vehicle in the first year you buy it, whether you bought it in January or December. You can write off up to 100%. We say up to because of that personal use piece. If you're using it 40% for personal use and 60% for business, you can only write off 60% of it. But it allows you to write it off the year you buy it. It's a great tax savings tool. There are a couple of caveats that I really, really have to mention before you go out and buy that car. So the first one is, if you are incorporated, it has to be in your business name. It needs to be bought by your business. If you need to get creative with the financing, we can come up with ways to do that, but the business needs to purchase that. It's less of a bright line if you're a sole prop, but if you're incorporated, please buy it in your business name. Save a lot of headache later. The second piece to this is that this is not a trick you should use every year, because what happens the next year when you trade it in, or 5 years down the line, whenever you trade it in, is the IRS makes you go look to see if you made money on it. And when it looks at what they call a gain on that sale, it takes into account anything you've written off. So if you got to accelerate that write-off for that vehicle last year, say you bought a $50,000 vehicle, you wrote off $50,000, and the next year you go trade it in and it's still in great shape and you trade it in for $50,000, last year you had a $50,000 deduction, this year you have $50,000 of income. So it does not make good tax sense to do this every year. This is a great thing to do every few years, as it is natural that you would be ready to replace a new vehicle. But if you try to do this trick every year, you're basically going to wipe out the savings. So say next year, you say, oh, I want to trade this one in. I want to get another one. That's $50,000. So you're going to have $50,000 write-off, but you're going to have the $50,000 of income from last year's vehicle that you traded in. And it's a net zero impact. So you still have a nice new car. If you trade it in and you don't buy a new one and take 179 again, then you've got a big tax increase. So definitely something that is a great tool. But it comes back down to what do you actually need for your business? If you buy a new vehicle every few years, this makes sense. it's going to be a great write-off for you. If you try to do this every year just for the sake of getting the Section 179 write-off, you're going to see diminishing returns really quickly.
So talking about depreciating different types of asset classes, Louisa, do you want to talk about maybe costs segregation and talk to us a little bit about how we can use that for our advantage?
Yeah. And this is a tool that I see a lot of agents take advantage of, not necessarily through their agency, but through their other investments. I love when I'm in a room with a bunch of agents to ask them how many of them own their own building. Normally, quite a few of them raise their hands. It's a really common investment strategy we see from these agents, that they purchase the building their office is in. It's a great investment tool. Real estate is always a good place to put your money, at least from what I've seen so far. So it's very common. And there are great tools around that as well. So a cost segregation study, to take a step back and think about this, the same applies for vehicles, but it becomes really impactful when you own a building. The IRS has different rules for how many years you have to take to write off a purchase, based on how long they think that purchase realistically is going to be useful for. A vehicle, like we talked about in the last section, if you don't take any of that accelerated Section 179, you write it off over 5 years. All right, the IRS expects you're going to drive a car for 5 years, so you need to take the deduction over 5 years. Commercial real estate, commercial buildings, the IRS says those are going to be good for 39 years. So if you buy a building this year, you have to take 1/39th of a deduction every year for the next 39 years. Great, it's a write-off. It's probably not that impactful year over year. But what really is in that building that you purchased? There's not just a building. There is HVAC. There is flooring. There's landscaping. There's windows. There's framing. There's draperies. All of these things that you purchase all made up that one cost. In this example, we're using $1 million. And so what a cost segregation study does is it's very in-depth, and it comes in and it breaks in that $1 million you paid, not into, hey, here's one building, you get to take it over the next 39 years, but into all of the different components that make it up, all of which the IRS has different lives for. Some of them are 15, some of them are 5, some of them are 7. And it breaks it up so that $1 million is actually made up of all these different components. And then we couple that with, so that on its own gets you more write-offs, because 5 years is a lot shorter than 39 years. But then you couple that with those accelerated depreciation tools that are out there, bonus depreciation for those shorter lived assets. And there are a lot of those in the 5 and 7 year category that you can actually take all the first year you buy it, just like that vehicle with the 179. There's more accelerated depreciation. And so we accelerate our tax savings. We take, rather than $1 million divided by 39, we take $250,000 of tax write-offs this year in this example, which saves you this year $50,000 of taxes. An important thing to think about with this and with the Section 179 on the last topic we talked about is these are accelerating depreciation, accelerating deductions. They're not creating deductions out of thin air. If you don't do a cost seg, you will eventually deduct $1 million. It will take you 39 years, but you will write $1 million off on your taxes. If you do a cost seg, you will write more of that off sooner. You'll save more taxes today. Time value of money tells us we want to accelerate our tax savings. It's more impactful. It's more money in our pocket. We can make that money do more for us today. So cost seg is not going to change how much you get to write off eventually, but it will bring so much more of that forward for you that you'll see huge tax savings in the year you spent the cash or got a mortgage. If you had $1 million of cash, that's amazing. But most of you probably are at least putting some of that on financing.
Now we get to talk about one of my favorites. I think just because the story of how it came to be is so cool, Louisa, that folks were renting their houses out for the masters. And so this has become known as the Augusta Rule, correct?
Correct. I am not a golf nerd, so I had to learn the origins through the tax side of things, but that's exactly where it came from. And the idea was that these people wanted to rent their houses out and make a quick buck because, my goodness, could they make a quick buck when the Masters came to town? I like to use a different example because I am up here in Packers country, and anybody who's ever gone to Lambeau Field knows that every person in a 20-block radius sells parking on their lawn. So I like to think of this as that rule as well. But the Augusta Rule says that you can rent your property for up to 14 days. You can rent it out personally. I can rent my house out to somebody for 14 days, and I don't have to put it on my tax return. If I go over 14 days, it's reportable income. That's great as a bottom line, but what does it mean for agents? What does it mean for business owners? The way that this has been put into practice, and it's a great tax rule, a tax strategy to take, is you can have your business rent your house and write that off at a fair market rate, whatever that is. Say you want to bring your team over for a party this afternoon, a party one afternoon, or you want to have quarterly meetings, monthly meetings at your house where you kind of bring everybody over and you use your house to do it rather than renting out a conference room. You bring folks to your house. You pay yourself. Your business pays you personally, cuts a check to pay you for that rental time. It goes from your business account to your personal account. The money still belongs to you. But it's a write-off for your business. And as long as you stay under that 14 days, you as an individual don't have to put it on your tax return as income. So it's a great way to write off some additional savings and some rent expense, while really just kind of shifting your money from point A to point B.
So this is a really interesting strategy here, Louisa, that I'm not sure how many folks know about, but the state pass-through entity tax. Talk to us a little bit about that.
This is something that is a current trend that we're seeing more and more states adopt. And as a tax nerd, I'm really excited about. I think this is a really, dare I say, cool thing that states are doing. Keep it in context, cool means different things for me than it probably does for you guys. But if you recall back to 2018, that big tax reform came through, a whole lot of things happened. So I'm not going to quiz you here, but one of the things that happened was part of the itemized deductions has always been writing off your property taxes, your taxes you paid to the state, any local taxes. And there was never a cap on that. So if you were a high income earner, if you had a bunch of properties, if you lived in a high state with a really high tax rate, California and New York, you probably wrote off as part of your itemized deductions $15,000, $20,000, $25,000. What that tax reform did is it said, I don't care how much you pay, you can only deduct up to 10. 9, 8, 9, 10, you can deduct 100%. Once you get to 10, it doesn't matter how much more you have. In states where they had those higher tax rates, this was super impactful. It hurt a lot of taxpayers. And so the states got kind of peeved, and they started looking for ways to assist and kind of work around it. And this pass-through entity tax is one of those workarounds. So this applies to incorporated entities. So it's not, if you're a sole proprietorship, you can't take advantage of this, but this applies to incorporated entities. And it's a state by state law. They all have slightly different rules. So you have to check into what your state is saying. But essentially, it allows you to check a box, make an election, and say, normally, my entity, my company, my S Corp, pays taxes on my personal tax return. We call it a pass-through or a flow-through entity. Any money my company makes, my business makes, it ends up on my personal taxes, and I pay both my state and the federal, all from my personal bank account or from my business bank account, but then I treat it as a draw. What the states are saying with this election is they're saying, I don't want you to do that anymore. I want you to check the box, and I want you to elect to have your business pay taxes instead of you paying it to us personally. Big deal. What does it matter? What it matters is it becomes a business expense, not a personal expense. So it doesn't get included in that $10,000 SALT cap up above. It is a separate expense. Your business income is $10,000 lower. You paid your state taxes, there are a big bulk of them. And then your SALT cap can still include your other personal state taxes. You paid your property taxes, things like that. But it allows you to pay the business taxes separately and not have it count against that $10,000. And so it's a really great tool to get a little bit of extra write-off that these states are putting in here. And most of them that we are seeing so far, again, remember this is trending right now. It's happening as we speak. Most are a year-by-year election, which means you can only take it in the years you're profitable and it makes sense. You don't want to do this if you have a loss. You want all the loss to go through to your business or to your personal. So you can evaluate it every year. So you have the ability to kind of pick and choose. Other states have different deadlines, so it is important to keep an eye on when the deadline comes through for your state. If you missed it for this year, look into it for next year. See what options you have.
So I know a lot of things came out of COVID, and this was probably a super interesting one for a lot of small business owners. Louisa, the employee retention tax credit. Let's talk about that.
Everybody's talking about that. And as they should be. So this is probably, if you know anything that came out of the COVID legislation, it was this or the payroll protection loans, and this is the one that has lingered. So this is a great tax credit if you are eligible. The headlines you're seeing right now, as we're kind of towards the end of the program, are more on the not so great side of things. But we do want to encourage you that if you have not taken this yet and you really truly qualify to take advantage of it, it's a great credit. And there are two different ways you can qualify. The first is as an established business. The second is as a startup recovery business. I will say that in our experience, what we've seen with agents, almost zero of you qualify as an established business. Um, Tends to be that insurance did pretty well during COVID. So one of the things as established business, you have to show a 50% decrease in revenue quarter over quarter, and a 20% from 2019 to 21. So there are pretty significant decreases in revenue that you have to show to be to qualify as an established business, or you have to have a full or partial work stoppage. Generally speaking, that didn't happen. You can insurance, just like accounting, we could work from home. So we didn't have that government ordered shutdown. So for agents, we generally have only seen them qualify as that startup recovery business. And that startup recovery business is if you opened your doors after February 15th, 2020, you were trying to start your business when COVID hit, is basically where that comes in. So you had less than $1 million of revenue in 2021. You had employees in Q3 and Q4 of 2021, and you opened after February 15th, 2020. Those are very black and white yes or no answers. If you can answer yes to those, you qualify as a startup recovery business. And then you are able to go get basically a percentage of your employees' wages back as a credit. And so it's a great program. It was really intended. I mean, what it's intended for is in the name, employee retention tax credit. The whole point of this credit is so that businesses could keep running, they could pay their people. Really want to caution you, as long as we're talking about this here, there are a lot of companies out there that are preaching that everybody qualifies for ERTC. And basically what they are doing is they're looking at that very last point on our slide where it says full or partial work stoppage or supply chain and saying everybody had that to varying degrees, and they were qualifying pretty much anybody who comes through their door for this credit. And the reason they're doing that is because they are charging a percentage of the credit as their fees. We at Club Capital, we charge a flat fee for ERTC filings. I don't care if you're getting $20,000 back or $100,000 back. We charge a flat fee. These companies out there, they're generally charging a percentage. So they are incentivized to qualify you and qualify you for a high amount. Not saying that every company out there is doing that. Certainly there are other companies that are legit and really working hard on behalf of these clients that they're getting. But do want to caution, just because we're seeing a lot of kind of these ERTC mills pop up. I was just listening to a podcast last week talking about this. They are talking about it on Capitol Hill. The IRS at this point is mostly caught up, according to them, on filing the claims and the amended tax returns that claim these credits, and they can now audit them a little bit. So we're going to see more and more topic of conversation on ERTC. It's going to be less on who qualifies and more on who took it and didn't qualify and what happens now.
So again, when we talk about this shift, to bring it back to where we started, going from an operator to an owner of your business, it's really about knowing your numbers. And part of that goes to what's the difference between profitability and cash flow. Something we always like to joke about is you can't fill up the gas tank with profitability. It's an accounting concept, but cash you can go buy things with. So yes, focusing on profitability is important, but we also need to make sure that we have cash on hand, and that's why cash flow statements are absolutely critical. It's just really important to keep an eye on everything, both your P&L sheets, your cash flow statements, your balance sheets. Knowing your numbers is critical, making that shift from operator to owner of the business.
Yeah, absolutely. And to bring it back on that tax side of things, because that's who I am, that's where I default to. Really, we just talked about a lot of strategies. None of those work unless, one, you have profit, so you need it. Profit is what's flowing through to your tax return. So that profit is important from that perspective. So we have to have the profit. The profit's there. We have a need to come up with some tax saving strategies. But two is that cash flow. What do we have available? One of the biggest things we see through these small owned, closely held businesses are you are pulling out of money out of your account because it's yours. But as you do that, your cash is dropping down, and maybe you needed to put that as a down payment on a non-business vehicle, as a home, whatever it is. Profit is what leads us to want to do tax strategies, but that cash flow is what allows us to. Take it back to what we said before I started talking about the specific options. Most of these require cash outlay. You can't put your kid on payroll if you don't have cash to pay them. So not only do we need to have that profit, but we need to have that cash flow available. And so understanding where both pieces are going, being in your numbers, so you can see not only, hey, how's my business profiting, but hey, where am I at my bottom line? Can I pay my people? Can I pay my vendors next week? Let alone, can I think about some big tax strategies? Both of those have to be work in concert with each other and go hand in hand. You can't only look at one of them.
One of the things, again, that we really focus on at Club Capital is making sure that you're prepared as a business owner to face all the challenges that come up in your day-to-day life. And we really recommend our podcast. We started the podcast as a leadership podcast to help you learn, help you hear other problems, how other people have overcome their problems. It's just a really great wealth of knowledge. I was listening to one the other day. It talked about comp plans for your producers. Super interesting stuff. So highly recommend you subscribe to the podcast.
Yeah, we have some great guests on there. Craig Wiggins. My favorite that we tend to highlight is we had a VP of sales from Chick-fil-A on here, Mark Miller. Some really great people who have been doing this a lot of times in different ways, different scenarios, and letting us learn from them. So taking advantage of that. It's a free podcast. So please listen in, go pick and choose some topics that look good to you, or just start from the beginning and work through.
Well, thanks for having us. We really appreciated our time. Louisa, I know I speak for both of us when we say it's been awesome to share this time with you. If you want to learn more about Club Capital, please head to our website. We do only work with insurance agency owners, and we really provide 3 services that, as you make that shift from being the operator to being the owner of your business, that our clients have reached out to us because they need help with strategic accounting. They need help with CFO services to help them make decisions, whether or not they need to hire another producer, whether or not they have the cash to hire another producer now, whether they should wait 6 months, 3 months. Those are the types of decisions that we're helping our clients with based on our industry knowledge. And then you heard from Louisa today. The tax side of things, that's where we can really help your business too. So we'd be more than happy to have a conversation, see if you're a good fit for Club Capital. Please reach out to us. We'd be happy to chat with you.
Every business owner needs partners. They need advisors. They need people to bounce things off of. And that's where we come at from the advisory space and from the financial space. One of the things that I love to tell clients as I start working with them and I start to build a relationship is that I know I'm weird because I love this stuff. I am an accountant because I like it, because I like to be in the numbers. I like to do the nitty gritty. I like to talk about it. I like to talk about taxes, which I get is strange. All of that to say, let me do what I'm good at and you go do what you're good at. Let me take that stress off your plate. Let us work together. Let us show you these numbers so that you can go take your time and invest it where you are most skilled and you are most talented. I can't go get policies for you. I'm a terrible salesperson, but I can give you the numbers and the forecasting of what's going to happen with those policies. Or go spend time with your kids, with your family, make whatever choice you want to make with that time that we're going to give back to you. But let us take on the stuff that's just a pain in the butt because we strangely really enjoy doing it.
And isn't that what being a business owner is about, Louisa? Just making sure that the right people are doing the right job so you can spend time doing what you want to do and living the life you want to live. And so we're here to help you with that. Don't hesitate to reach out. We'd love to hear from you.